Have you ever been there, you're staring intently at a stock chart, maybe it's 5 minute, maybe the 15, and every single signal is just screaming, go! You see what looks like an absolutely perfect breakout, volume surging, prices moving with conviction, everything just aligns, and that rush of excitement hits you right. You feel like you've just spotted the next big move, the one everyone else is gonna miss. So you pull the trigger, you enter the trade, and then boom! Almost immediately it reverses, not like a gentle correction, not a little wiggle, but a full-blown head-spinning U-turn. Often it slices right through your stop loss, leaves you with a quick, painful loss, and that surge of excitement, it instantly turns into this cold, sinking feeling. You're left wondering, what on earth did I miss? How could this have gone so wrong when it looked so perfect just moments ago? It's a classic gut punch, isn't it? You feel utterly caught in the market's noise, like you're trying to navigate a stormy sea by only looking at, a single isolated wave crashing near your boat. It's like trying to navigate a bustling city by only looking at the pavement right under your feet. I mean, you might avoid a puddle, sure, but you'll never see the oncoming bus or that shortcut down the next block. That's what Brian Shannon vividly calls single time frame myopia. It's not just bad luck when your perfect breakout reverses. It's a fundamental blindness to the market's true, powerful currents. You were so focused on the immediate foreground, that 5-minute chart, that you slammed right into a major resistance level on the daily or weekly chart. A brick wall you couldn't see because you just weren't looking up. It's like trying to win a chess game by only looking at one square, totally oblivious to the entire board. So what if you could quiet that noise? What if you could truly see the market's underlying tide, understand the grander narrative, and grasp not just what a stock is doing right now, but crucially why it's doing it, and even more powerfully, what it's likely to do next? That's not some pipe dream, a hypothetical scenario just for the pros. That's the core promise of understanding market context. Today, we are undertaking a deep dive into Brian Shannon's truly seminal work, Technical Analysis Using Multiple Timeframes. This isn't just another trading book. It is really the definitive guide to unlocking that crucial multidimensional understanding of market behavior. Our mission in this deep dive is to unpack Shannon's practical, systematic framework. We want to give you an actionable solution to overcome those frustrating trading consistency issues, to move beyond just reacting, and instead understand the market's grander, more powerful story.
And that's precisely where Shannon truly excels. He takes what often seems like chaotic, random market behavior, those frustrating price moves that feel like they're designed just to trap you, and he distills it into a recognizable, predictable cycle. It's a fundamental insight, really, a paradigm shift. Once you grasp it, you genuinely can't unsee it. His book makes it crystal clear. Without the proper context from multiple time frames, you are essentially trading blind. You're just reacting to isolated moments without understanding their place in the bigger picture, which, let's be honest, dramatically stacks the odds against you in this probabilistic game.
So we're talking about moving beyond just staring at one chart, right? The idea that there is a deeper rhythm, a kind of underlying structure at play.
Absolutely. Think of it like a symphony. You wouldn't judge an entire symphony by listening to just one note, would you? Or even one instrument playing alone. You need to hear how all the instruments blend, how the different movements unfold, how the themes develop over time. The market is precisely the same. Each time frame is playing its part, and only by listening to them all, in concert, can you truly understand the composition.
That's a brilliant analogy, and it leads us directly to the absolute bedrock of Shannon's approach. This idea that all time frames are not created equal. This isn't just a casual observation, it's a profound recognition that the market is inherently fractal. Now, for those maybe not familiar with fractal, we're talking about a phenomenon where patterns repeat themselves at different scales. Doesn't matter how much you zoom in or out. Think of a coastline, right? You zoom in, you see smaller bays and peninsulas that look strikingly similar structurally to the larger ones. Or imagine a tree. A small branch looks like a smaller version of the whole tree with its own twigs and leaves, itself similar patterns repeating at different magnitudes. The market operates in precisely the same way. You have trends within trends within trends. A stock, for instance, could be in a multi-year bull market on its monthly chart, showing consistent upward progress. But simultaneously within that larger bull trend, it might be experiencing a significant intermediate-term correction on its weekly chart. And then within that weekly correction, it could be enjoying a short-term rally on its daily chart. It's layers upon layers of market action, all unfolding at the same time, creating that apparent chaos if you only focus on one layer. Shannon's fundamental premise is that a trader's primary objective isn't just to identify any old trend, but to align themselves with the dominant trend, the one seen on the higher, more powerful timeframes. And then only then do you use smaller timeframes to pinpoint those low-risk, high-probability entry points that are aligned with that bigger picture. It's about ensuring the overwhelming force of the market's tide is behind your tactical move, not fighting against it. It's a concept that, honestly, once you internalize it, it transforms your entire approach.
Exactly. And to manage this complexity effectively, Shannon doesn't just vaguely suggest, glance at a few charts. No, he provides a highly structured, actionable 4-timeframe model. It's designed specifically to give you that holistic top-down view. Each time frame in this model has a unique, distinct purpose, a specific role it plays in building your overall market picture, and ultimately your trading plan. It's a systematic approach. It builds context methodically, starting from the broadest view and progressively narrowing down to the precise point of execution. This is where the discipline of his method really shines. So first, at the very top, we have the monthly chart. He aptly calls it the strategic map. This is your true 30,000-foot, maybe even 50,000-foot view. Its primary role: provide the absolute biggest picture of a stock, an index, whatever you're looking at. You're using it to identify the very long-term trend, the multi-year cycle, and those critical, almost immovable historical support and resistance levels, the ones that have held for years, sometimes decades. Imagine seeing a stock that's been consolidating for 5, maybe 10 years, building an enormous base on its monthly chart, maybe a multi-year rectangle or a large ascending triangle. When it finally breaks out of such a monumental base that's incredibly significant, potentially a life-changing event for someone positioned correctly, that's a completely different scenario. From a stock just bouncing around the middle of some large established range on the monthly chart, it gives you perspective. Now, you are not trading directly off this chart. It's way too slow for active trading. But your awareness of these massive overarching trends and these deeply respected historical levels, absolutely non-negotiable. Ignoring it means potentially walking directly into a generational resistance or support level completely unaware, which, as we said earlier, is just a recipe for getting stopped out immediately. It's the highest level of context, informing everything else.
Right, so it's about seeing the entire mountain range before you even think about climbing a specific peak. That makes perfect sense. And then, once you have the strategic, decade-spanning view from the monthly, where do we go next? How do we get a more actionable sense of direction?
That's where the weekly chart steps in. We can call this the compass. Its role is to confirm the direction established by the monthly, but it starts giving us the weather report for the journey ahead, something more relevant for medium-term trades. It helps you identify the intermediate-term trends that might last several months, maybe even a year or two, and those key support and resistance levels that are more immediately relevant to position trading. Its utility is essential for gauging the health and momentum of a market move. For instance, if your monthly trend is undeniably up, confirming a long-term bull market, but then the weekly chart suddenly prints a large, wide-ranging bearish reversal candle right after an extended run, say, a bearish engulfing pattern or maybe a large dark cloud cover where sellers clearly overwhelmed buyers well, that's a critical warning sign. It tells you that while the super long-term trend might still be intact, the intermediate-term momentum is definitely shifting. A significant pullback or even a full reversal could be brewing. This is your compass, guiding your journey within that broader strategic map.
Okay, so the monthly gives us the ultimate destination. The weekly tells us the general direction and warns us about major storms ahead. What's next for the day-to-day navigation, the actual planning?
Then we get to the daily chart. This is your tactical plan. This is the primary workspace for most active traders, where the bulk of your day-to-day analysis and trade planning actually happens. You use the daily chart to fine-tune the direction you've already established from the weekly and monthly charts. It's crucial for planning specific entry and exit strategies, identifying precise areas for stop losses, and managing your trades day-to-day or week-to-week. It provides the clearest view of the short-term trend within that larger context we keep talking about. This is where you look for those classic chart patterns, things like flags, pennants, triangles, head and shoulders, maybe even simple moving average crosses. These allow you to plot your exact moves for the coming days or weeks. This is where you connect the broad strategic direction with concrete, actionable plans. It allows you to see the individual waves, but always knowing the direction of the underlying current.
Got it. So the daily chart is where we put the plan into action, refine the strategy, but we still haven't talked about exactly when to pull the trigger with precision. Where does that fit in?
Precisely. And finally, we have the intraday chart. Shannon calls this the trigger. This could be your 60-minute, 30-minute, 15-minute, or even 5-minute chart. It really depends on your trading style and the volatility of the asset you're watching. And this is absolutely crucial, and a point that so many new traders completely misunderstand. The intraday chart is explicitly not for determining direction. Let me repeat that. You should never ever be trying to figure out if a stock is going up or down or if a trend is starting, based solely on its 5-minute chart. That's a recipe for disaster. Its sole purpose is trade execution. Use it to find the precise moment for entry or exit, to get the absolute best price possible, to minimize your initial risk, and to maximize your efficiency. Based on the comprehensive plan you've already developed on the higher timeframes. Think of it like the sniper scope on a rifle. Once you've identified your target, assess the wind, plan your approach. This is what gives you the perfect, low-risk shot. Without that higher timeframe context, looking at an intraday chart is just a blurry, chaotic mess. It will absolutely lead you to make impulsive, usually wrong decisions.
And this leads us directly to what Shannon calls his absolute golden rule. You must never, ever make a trading decision based solely on one time frame. This isn't just a suggestion, it's a foundational principle. If you ignore it, you will consistently find yourself in frustrating, often immediate losses. Think about it. A seemingly compelling buy signal on a 5-minute chart, maybe a strong green candle rising volume, looks great. Is often completely meaningless and frequently a devastating trap if the daily chart is deep within a strong established downtrend. Or worse, if the weekly chart is showing clear signs of topping out after a significant run. The smaller time frame is always subservient to the larger dominant trend. It's like trying to sail across an ocean by only looking at the ripples right in front of your boat, completely ignoring the massive current pulling you in the opposite direction. You might feel a tiny breeze pushing you forward momentarily, but the overwhelming force of the tide dictates your true course. This rule is designed to save you from getting swept away by fleeting, deceptive moves and keep you aligned with the true path of least resistance.
Absolutely. Now, beyond understanding that powerful relationship between timeframes, Shannon introduces another absolute new fundamental concept. This is really the engine of his method. The idea that every stock, regardless of the time frame you're looking at, predictably cycles through 4 distinct stages. This isn't just random market noise, it's a profound reflection of human psychology playing out on the charts. That ebb and flow of optimism, fear, accumulation, distribution, it's all there. And he stresses that recognizing the current stage a stock is in, on all relevant timeframes, is absolutely paramount for consistent trading success. Misidentifying the stage or ignoring a stage transition on a higher time frame, that's a fast track to being on the wrong side of a major market move. It's really about understanding the natural life cycle of price action.
So if these are the 4 distinct acts of the market's play, let's break them down. Because understanding them deeply is, well, it's like having a roadmap to almost all market behavior. It gives you foresight into what's likely coming next. First up, we have stage 1, basing, also known as accumulation. This is the quiet phase. It typically happens after a stock has had a significant, often prolonged decline. The selling pressure has basically exhausted itself. The stock essentially stops going down. Instead, it begins to move sideways, usually in a relatively tight, well-defined range. Visually, you're looking for low volatility. The price action flattens out, almost like the stock is taking deep breath after a long, painful fall. Often the volume will dry up significantly during this period. That signals a lack of widespread public interest or panic selling. It's a period of equilibrium, a real lull. However, what's fascinating and crucial is you'll also start to see occasional, sometimes subtle, volume spikes on up days within that base. These aren't dramatic headline-grabbing surges, usually. They're often quiet, persistent increases, but they're powerful clues. They signal that smart money institutional investors with deep pockets are quietly and methodically buying or accumulating shares. They're scooping them up from the weary, disheartened public who've probably given up on the stock. It's the calm before the storm, the foundation being laid for the next big move. You'll often see long-term moving averages like the 200-day or the 40-week SMA or EMA start to flatten out, maybe even slightly turn upwards as price consolidates above them. That confirms the downward momentum has truly run out and accumulation is happening below resistance.
Exactly. And following that period of quiet accumulation, if the smart money has successfully built their position, we then transition into stage 2, advancing or markup. This is the stage every long bias trader dreams of being in. It begins when the stock decisively breaks above the resistance of that stage 1 base. This breakout is usually not subtle. It's a powerful move, often on high volume, signaling a clear shift in market dynamics. This is the ideal trending stage for long positions. The path of least resistance is clearly upward, almost like an open highway. Visually, this stage is characterized by a consistent, rhythmic series of higher highs and higher lows. The price action feels strong, confident, relatively smooth, like a well-oiled machine just steadily moving uphill. You'll see moving averages, which were perhaps flat or declining back in stage 1, begin to slope strongly and consistently upward. They often provide dynamic support as the stock climbs, Volume tends to be higher on the up days and lower on pullback days, confirming the strength of the buying interest. It's during this stage that the stock progressively gains public attention. Slowly at first, then more rapidly, as new buyers, driven by a mix of positive news and that fear of missing out, FOMO jump aboard, pushing the price higher and higher. This is where the real trend following money is made.
But, as they say, all good things eventually come to an end. Which leads us to stage 3, topping, also called distribution. After a significant, often exhilarating upward run in stage 2, the advance stalls. The stock begins to move sideways again, much like it did in stage 1, but this time it's happening at the top of a large expended move. This stage is where smart money, who smartly accumulated at the bottom in stage 1, is now actively selling. They're distributing their shares. And who are they selling to? Often the late-coming public. These are the retail traders finally buying in, driven by excitement, that lingering FOMO, and an almost irrational belief the stock can only go higher. Usually fueled by the latest good news or analyst upgrades hitting the headlines. How do you spot it? Look for increasingly choppy, volatile price action within a defined range. The stock struggles to make new highs, even on seemingly positive news or strong earnings reports. Often retreats quickly from those attempted breakouts, creating what look like fake-outs. Volume can remain stubbornly high or maybe even spike on down days, yet the price makes little or no net progress. It's like pushing a car uphill with the brakes on. This is arguably the most dangerous stage for unsuspecting traders, because it often deceptively looks like just a simple pause, a healthy pullback, or a consolidation before another leg up. So many traders get trapped buying the highs here, thinking they're buying a dip in a stage 2 trend, when in reality they're buying right into the smart money's exit strategy. Moving averages might start to flatten or even cross over, signaling a loss of that upward momentum.
And if the distribution is successful and the buyers eventually dry up, the stock then enters stage 4, declining or markdown. This stage marks the decisive breakdown below the support established during that topping pattern. This is a sustained downtrend, a period where traders should either be shorting the stock aggressively or, if they're long-only investors, avoiding it entirely. Visually, this stage is unmistakable and often brutal. You see a breakdown on high volume, often with a large, wide-ranging bearish candle, maybe a full-bodied red candle with minimal wicks. That's followed by a clear and consistent series of lower lows and lower highs. Shannon vividly describes it as a waterfall of pain for those who bought near the top. It's just a relentless downward grind. Every attempted bounce, every small rally is met with fresh selling pressure, systematically eroding capital for anyone holding a long position. Moving averages, which were previously supporting the price, now act as dynamic resistance, sloping downwards. It's the mirror image of stage 2, only in reverse, driven by panic, forced selling, margin calls, and a complete loss of confidence. Now here's the absolute critical interplay.
This is the key insight that ties all this together and gives Shannon's method its immense power. The necessity of analyzing these 4 stages across multiple timeframes simultaneously. This is where the deep understanding truly lies. A stock might appear to be in an undeniable stage 2, advancing, on your daily chart, showing a beautiful textbook series of higher highs and higher lows, strong moving average alignment. Everything looks perfect for a long trade. But if you then look at the weekly chart, you might observe that the stock is just entering stage 3, topping, perhaps having printed a massive bearish reversal candle like a shooting star or a bearish engulfing pattern. Or maybe it's just starting to move sideways after a huge multi-month run right into a significant resistance zone.
Okay, so in that scenario, what do we prioritize? The daily signal looks great, but the weekly is flashing warning signs. Which one wins?
In this scenario, the weekly signal absolutely trumps the daily. It's telling you that despite the apparent short-term strength on the daily chart, the overall intermediate-term advance is likely nearing its end. A much larger pullback or even an outright reversal is probably on the horizon. The smaller timeframe strength is likely just a temporary rally within a larger distribution phase unfolding on the weekly. Maybe a last gasp before the inevitable stage 4 decline begins. Recognizing this allows you to avoid those costly traps, that initial perfect breakout on the daily that fails almost immediately, and instead align your trades with the most dominant, powerful forces in the market. It's the difference between trying to paddle upstream in a strong current versus just letting the current carry you downstream. You want the wind at your back.
Right. Let's make this really tangible now. Let's walk through a realistic, almost classic scenario that, without this multiple time framework, would typically trap countless traders. This is the setup that turns hope into pain real quick. Okay, imagine the setup playing out on your screens. You're looking at a well-known stock, let's call it global tech. On the monthly chart, you see it's been in a long-term, undeniable bull market for years, steadily climbing, respecting an underlying trend line. Its 10-month EMA, let's say, has consistently held a support for the past 5 years. However, crucially, it's now approaching a significant historical resistance area, a previous all-time high from maybe 10 years ago, a level it's bounced off multiple times over the past decade. It's not just a minor hurdle, it's a major historical ceiling. Then you check the weekly chart. This chart confirms the overall bull trend, no doubt. Gold tech has been on a fantastic multi-month run, maybe up 50% in the last 6 months alone. However, just last week, right as it nudged up against that monthly resistance, it printed a large, wide-ranging, bearish candle, perhaps a prominent dark cloud cover, where sellers just engulfed the previous week's optimism. This happened after an extended, somewhat parabolic run. This is strongly suggesting it might be entering stage 3, the topping or distribution phase, on this intermediate time frame. It's an early but critical warning signal, a subtle but significant shift in momentum right at a critical multi-year juncture. The weekly 10 EMA is still pointing up, maybe, but the pace has definitely slowed, and that bearish candle is a serious red flag. Now you zoom into the daily chart, and here's where the trap springs for the unprepared trader. After that strong bearish weekly candle, the stock has pulled back, seemingly in a healthy way, to a commonly watched support level, like its 50-day exponential moving average, EMA. To a less informed trader, someone only looking at the daily chart in isolation, this looks like a textbook healthy pullback, a prime buyable dip. The 50-day EMA is holding, it looks like a perfect bounce, maybe even with a small bullish candle today confirming support. Your brain is screaming, this is it! Time to buy this dip and ride the next leg up. You're so focused on that daily bounce, that apparent continuation of the short-term trend, you completely miss the much larger, more ominous signals from the higher time frames. You're blind to that impending brick wall on the monthly and the warning shot on the weekly.
And this is precisely where applying Shannon's framework prevents you from falling into that classic painful trap. Your multiple time frame analysis immediately screams caution. The higher time frames, the weekly and especially the monthly, are sending very strong, undeniable warning signals. The monthly chart highlights that long-term historical resistance, indicating this exact area has consistently been a ceiling for years, maybe decades. The weekly chart, with that big bearish candle and the loss of prior momentum, confirms the intermediate-term momentum is waning rapidly. It suggests the stock might be transitioning into stage 3 distribution. It's telling you that the dominant intermediate trend, despite the daily chart's apparent strength, is losing steam right as it hits major overhead supply. So while the daily charts bounce off the 50-day EMA looks like a viable pullback in isolation, and okay, maybe it is for a very quick scalp trade, our deeper multi-time frame analysis reviews it's likely just a temporary pause, probably within a much larger distribution pattern unfolding on the weekly time frame. It's just a short-term rally within a longer-term weakening trend.
The smart play here, the high probability play, is to wait. You avoid taking a long position based solely on that deceptive daily bounce, no matter how tempting it looks. Why? Because the probability of it reversing again from that higher time frame resistance or continuing its weekly stage 3 distribution is significantly higher than the probability of a sustainable push through that multi-decade ceiling right now. You understand the profound context?
Okay, so if buying is off the table because the higher time frames are waving red flags, what is the high probability trade here? Or is it simply a case of sitting on your hands, being patient, and waiting for more clarity?
Given this specific context, the only high probability trade you'd even consider thinking about would be a short position. And critically, only if the stock were to break below that daily support level, like the 50-day EMA that it just bounced off of. That breakdown would be powerful confirmation. It would confirm the weekly distribution that's already signaled. It would signal that the bears are indeed taking control, and the stock is likely transitioning decisively into stage 4, the markdown phase. It would be the final piece of the puzzle, aligning all the relevant timeframes downwards. And for that potential short trade, your risk management is incredibly clear. Your stop loss would be placed strategically just above the recent high of that topping range, maybe using the weekly chart's high as a guide. You know exactly where your trade idea is wrong before you even enter. And your potential reward, if a stage 4 decline unfolds, could be substantial, offering a very attractive asymmetric risk-reward setup.
And this is where the intraday chart, your trigger, finally comes into its own right. Once you've established your directional bias from the higher time frames, in this case looking for a short entry only on a breakdown, the actual execution happens on a smaller time frame. You'd watch for a decisive break of that daily support level on, say, the 15-minute chart. Ideally, this breakdown would come with a noticeable increase in volume, signaling real conviction in the move down. Maybe a heavy red candle breaking below prior intraday support. This isn't about guessing or just reacting to a sudden price drop. It's about precision timing based on a predefined plan. The higher timeframes dictated the strategy and direction. In this example, that the path of least resistance was now likely down, or at best sideways into a major top. The lower time frame then provided the exact point of entry, minimizing your initial risk and maximizing your potential reward. It's the ultimate example of aligning that big picture strategy with tactical, surgical execution. You're not trying to predict the future, you're simply reacting intelligently to the confluence of signals across timeframes, always respecting the larger narrative.
Absolutely. And what's truly fascinating here, and something often overlooked by people who only focus on the mechanics of drawing lines on charts, is that Shannon's wisdom extends far beyond just identifying patterns and stages. He transitions seamlessly from the technical tools to the absolutely critical psychological components of successful trading. Because, let's face it, having the best analysis in the world, the most perfectly crafted plan, means absolutely nothing if you can't execute it with unwavering discipline. The charts give you the roadmap, sure, but it's your mind that determines if you can actually follow it without deviating. First, he really drills home the profound idea that technical analysis is about probability, not certainty. This is such a crucial distinction, and honestly, it frees traders from an immense psychological burden. We are not predicting the future with 100% accuracy. That's impossible in a dynamic, complex system like the market. Instead, we are assessing probabilities. The goal is to consistently find asymmetrical risk-reward setups, where the potential gain significantly outweighs the potential loss.
For example, if you're risking $1 to potentially make $3, you only need to be right about 30% of the time just to break even, roughly speaking. If you can push that win rate higher through solid analysis, maybe even to just 40% or 50%, you instantly have a massive probabilistic edge working for you over the long run. This mindset shift frees you from that crushing burden of needing to be right all the time on every single trade. It allows you to focus on managing opportunities over a series of trades, understanding that each individual trade is just one data point, one experiment in a larger scientific process.
That reframing of being right versus managing probabilities, yeah, that sounds like it takes a huge amount of pressure off. It's not about your ego needing to be right, it's about executing a process with an edge.
Exactly. And that naturally leads directly into the absolute necessity of risk management, which Shannon stresses is paramount. He emphasizes with zero ambiguity that you must define your risk before you enter any trade. This isn't optional advice, it's the non-negotiable cost of doing business in this field. It's the tuition you pay to learn about the market's behavior. You need to know precisely where your trade idea is wrong, the specific price point at which your thesis is invalidated, and you have to acknowledge you were incorrect this time. And then, crucially, you must have the unwavering discipline to exit immediately if that point is hit. No hesitation, no hoping, no second guessing. He reframes losses beautifully. He explains that a small, controlled loss is simply a cost of doing business in a probabilistic game. Think of it as an information fee you paid. A large, uncontrolled loss, however, represents a fundamental failure of your strategy and, more importantly, your discipline. It's the difference between buying a movie ticket for a film you didn't enjoy and burning down the entire cinema because you refused to leave early. Uncontrolled losses are account killers. Small, managed losses are just part of the journey towards consistent profitability. He stresses over and over, protecting your capital is always priority number one.
It really sounds like this entire framework, the multiple time frames, the stages, the risk management, it builds a robust psychological defense mechanism against those common trading demons like fear and greed.
It absolutely does. And finally, the entire multiple time frame framework is designed specifically to cultivate emotional discipline. By providing a logical, systematic process to follow, by forcing you to look at the market through multiple lenses, it fundamentally helps to quiet those destructive emotions of fear and greed. These are the twin devils that derail most traders, leading to impulsive, irrational decisions that wreck accounts. When you're operating from just a single time frame, every little flicker of price action can trigger impulsive fear, maybe leading you to sell out of a perfectly good trade too early, or irrational greed leading to over-leveraging, chasing parabolic moves near the top, or refusing to take reasonable profits. But with a higher time frame context provided by Shannon's method, you have an objective map. You know where you are in the market cycle, you know your dominant trend, you have your tactical plan laid out, and you have your precise entry trigger identified. This structured approach significantly reduces uncertainty and guesswork. It makes it immeasurably easier to stick to your plan, avoid chasing those blow-off tops, and resist panic selling near the bottom. It transforms trading from an emotional roller coaster into a reasoned, systematic endeavor. It allows you to execute with the calm precision of, well, maybe not a machine, but a disciplined professional, rather than the impulsive reactions of a gambler.
So let's circle back to where we began today. That gut-wrenching feeling, right? Entering a trade full of hope and conviction, only to watch it immediately reverse against you, often for a painful loss. That was the consequence of trading the wave without respect for the tide, being a prisoner of a single time frame, totally disconnected from the powerful underlying currents of the market. You were reacting blindly to noise, to mere ripples on the surface, not responding thoughtfully and strategically to the profound context. Brian Shannon's technical analysis using multiple timeframes doesn't just offer tools, it really gives you the keys to your freedom from that kind of confusion and frustration. It provides a structured, logical, and repeatable framework for understanding the market's complete narrative across different time horizons. It teaches you to understand not just what price is doing right now, but why it's doing it, what forces are truly at play beneath the surface, and how what it appears to be doing in isolation might be misleading. It teaches you to see the entire chessboard, not just the single square right in front of you.
And what this method empowers you to do is truly profound. You stop guessing, you stop hoping, and you start analyzing with a clear, objective lens. You stop reacting impulsively to every tick, and you start planning strategically with a full, informed awareness of the larger market forces that are really in control. You trade with profound context, not just blind hope or some gut hunch. This framework allows you to become a more patient trader, a more disciplined trader, and ultimately a much more effective trader by consistently aligning your actions with the market's true dominant direction and its natural stages of progression.
Now, let's be absolutely clear. No book, no method, no guru can ever guarantee winning trades every single time. That's a fantasy, pure and simple. Anyone promising that is selling you snake oil. But Brian Shannon's work will fundamentally transform you. It can shift you from being a gambler, reacting impulsively to flickering screens, into becoming a strategic speculator. You'll start making calculated decisions armed with a clear, probabilistic edge derived from a deep, multidimensional understanding of market behavior. You'll trade with purpose. So the message is, turn off the noise, zoom out. Find the dominant trend, understand its current stage, and then, only then, go in for the kill with precision. That is the true, undeniable power of multiple time frames. Thank you for listening to this deep dive. Now go review your charts.
Hey listeners, if you enjoyed this podcast, don't forget to like and subscribe to our channel for more amazing content. And if you found value in this episode, share it with your friends. You never know who might need it today. Also, let us know in the comments if there's any of your favorite books you'd like us to review next. We'd love to hear from you.